This Twin Peaks Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to this festive Twin Peaks Investing Podcast special. For those of you that are on YouTube, you can see 8 squares. We're not squares, we are investing individuals who love to talk about stocks and shares. So welcome to this festive Twin Peaks Investing Podcast. On this podcast tonight, I have got my fantastic co-host with me, Henry Viola here. I've got Danny Wallace, who's absolutely fantastic speaker, presenter, talker, organizer of all things to do with financial education. I've got the man known as Matthew, get that correct, Matthew Gregory, who's Games Workshop's personal guru. I think he should be working for them. I've got Paul Edenbrough, former Twin Peaks Investing Challenge winner, the teacher, the headmaster, the tutor, the mentor, and also the musician. I've got Andy Spenno, who's on Twitter. We don't know much about him. We're going to find out a lot more about him on this pod. And Lewis, who I believe works in and around the UK, travels all over the place. He's got a diverse range of investment portfolio. He's going to talk about that. And we are going to be talking with our technologist, the ShareScope expert, Paul Hall, we've got with us tonight as well. We might hear a few stocks from him, but he's going to be doing all the magic in behind the scenes to showcase what stocks and investment trusts even and other aspects of ShareScope we can show live onto the screen. Is that correct, Paul?
Absolutely. Lots of graphics to be seen on screen.
Yeah, Paul's going to be showing us all that there is to see regarding the stocks and the metrics regarding what we're going to be talking about. Right, ladies and gents, we're going to kick off with our first guest on this live pod. And this is, if you can take your mic off there, Andy, this is going to be Andy, who is on X at Spenno 007.
Yeah, 006, sorry, Pete.
006, there was close but no banana. Okay, Andy, the idea behind this pod, ladies and gents, is that we're going to talk about how 2025 was for each of us. Talk about one stock that we want to highlight that performed really, really well for us, and possibly one stock that didn't do so well for us. Given time, we're going to try and get through as many stocks as possible. We're going to start with Andy. Andy's going to introduce himself, give us a little brief overview of who he is, what it's about, and his investing style before telling us about one stock he's really pleased about in 2025 and one stock he isn't. And then Paul is going to showcase that particular stock and share screen and show the summary page, etc. on ShareScope. So over to you, Andy, to introduce yourself and tell us about 2 stocks if you wish.
Brilliant. Thanks, Peter. And thanks, Peter and Henry, for inviting me on. I've been a long time listener to the show, and it's really helped with my investment journey along the way. So getting a regular check-in and really giving me some good ideas. So my name's Andy Spencer. Worked in the telecoms industry for many, many years, mostly on the mobile side of things. So if you see those things where it says like 2G, 3G, 4G, 5G, I've worked through all of those, mainly on the technical side to begin with, but more recently, in more recent years, looking after kind of account management and then sales. From a investing perspective, I'd say I'm a long-term investor, but not knowingly invested, because I'm of that generation where final salary pensions went out the window. Didn't really get explained what having a defined benefit pension was. To be left with maybe 5 or 6 different pensions floating around. So 5 years ago, I kind of took the mettle and thought, I need to get a grip of this because I'm going to retire at some point and I'm probably going to be very poor. So that's my investing journey. So still very young in terms of investing. I've only really been actively investing for 5 years. Started out on that kind of journey, I suppose a lot of people do, with kind of Vanguard, trying to amalgamate pensions. trying to understand all the terminology, which from a telecoms background is interesting because it's exactly the same. Lots of hard to understand terminology, but that's where listening to Peter and Henry really helps. From a stock perspective this year, the stock I've chosen is actually an investment trust. That's very much in my style of investing, and it's the Murray International Trust. The reason I chose that one is I've kind of got three global trusts at the moment in my SIP pension, and this one was supposed to be the quiet, ploddy, nice, dividend yielding, stable one out of the three. But actually, out of the three, it's turned out to be the best performing global trust this year. So it's interesting. And the reason I chose it was, again, for all the reasons mentioned, I like the dividend, I like the dividend yield, and when I'm looking forward to, pension in the future, that's part of my over investment strategy is to have some income coming in. But what I did notice was in the top 10, actually quite a few semiconductors, and these seemed a little bit out of fashion a couple of years ago. So if you look in the top 10 now of the portfolio, I guess the weightings have changed and they've probably trimmed, but sat in there was Taiwan Semiconductor, Broadcom, and also Cisco Systems was sat in there as well. So it was interesting to see those in a dividend kind of paying stock, and I guess this year that's really helped drive some of the performance. So if I check the total returns out for myself from the 1st of Jan 2025 on Murray International Trust, and that's including the dividends, currently my portfolio it's 32% this year. So it kind of shows that those sleepy, boring investment trusts that kind of plod along, every now and then they do bring you a surprise gift for Christmas. So that was my chosen stock really in the investment trust space.
That's a brilliant return, mate. 33%. We often talk about the fact that, the concern that Henry and I have is that a lot of people were looking for the dividend yield in infrastructure / trusts / real estate trusts, and they simply didn't get it. They had the discounts which were there, the buybacks, had Saba being involved, that boosted some of them, and some of them got taken over, lots of mergers and other activism going on, but they underperformed.
Yeah.
So actually looking for, like you say, the Murray International one, having a 33% return, that's outperformed the bulk of what's actually happened in the US, indices, and even the FTSE. I think in total, year to date, including divvies, about 22% ish. It's outperformed the US indices, but you've outperformed that as well with the Murray. Yeah, so having that, like you said, Taiwan Semiconductors, Broadcom, and Cisco's, they've all done exceptionally well and possibly carried that investment for you this year. So yeah, that's exceptionally well done and a good pick. How long have you held that one, Andy?
So I started buying, I think, about 2.5 years.
2.5 years.
I think I originally bought it when it was in a bit of a dip, and it was very out of favour. It was sitting on a big discount. But it was Bruce Stout was the manager, long-time manager for that trust. And I think he's recently retired, but his proteges have taken over, and I think they're doing very well with the trust. So, like I say, for me, it was just one trust in three global trusts. I like to have, different kind of styles, so that maybe one might outperform in 1 year and one may recover and have a bit of defence if possible. So. But it's just interesting with technology going so well this year. I thought some of the other trusts that I have, and I've just started buying JPMorgan Global Growth, but that hasn't actually done very well this year. But you would think that would be the outperformer. So it's been interesting, but I'll continue to hold.
Yeah, that's a good call. I think the difficulty some fund managers have is getting in onto thematic trends, sometimes belatedly, because they would have gone globally and gone, a year ago, we're not going to get involved in that AI race because we might get it wrong. So they've avoided it. Whereas Murray decided to go in and probably were in there early. So the investments that they had in Cisco, in Broadcom, in Taiwan Semiconductors has done exceptionally well because, the momentum that they gained over the past 12 months has accelerated that. and others have gone, we're not going to chase it, so therefore they've stayed out and been more conservative. But if they're in I've got this feeling myself, in a sense of, and we might talk about this in the other pod, is that the non-AI and smaller tech related companies could have their period in the sun next year or the year after, because of the outperformance that larger tech companies have had. I'm not sure if Henry's got any views on that, because Henry historically has been in favor of more exposure to investment trusts. Any thoughts, Henry, on this one?
Yeah, I mean, it's a very good name, Dick. I mean, Murray, very good manager, very good track record. And it's interesting that you say it's a sort of a plodding defensive type fund, because that was my impression of it. And you look at that 25+% return this year and think, blimey, that's really shooting the lights out. Interestingly, I think Paul's just moved off the screen, but on the forecasts, one of the things I quite like to look at on ShareScope is the forecast PE ratios, but also the forecast earnings growth and the forecast cash flow growth. Now that looks a lot more pedestrian for this fund going forward, and so I'd be interested if you get a chance to see any of the interviews with the fund managers, if they've got any views on that and whether they've got any views on how to accelerate it going forwards, because forecast cash flow growth of 5%, that's not really great over the long term. You really want to be, I would say, doubling that if you can. So it'd be interesting if you get a chance to put a question into them and just ask, have they got any views on increasing the growth rate moving forward?
Yeah, definitely. Yeah, it's definitely an important point to look at, Henry. And as you say, it's kind of why I try and spread the risk, even though it's an investment trust and even though it's got multiple holdings. Having been burnt early on in my little journey, trying to hold some bigger trusts and not done very well, it's definitely why I try and at least have 2 or 3 different managers with different styles. And I guess, Peter, back to your comments around the infrastructure space or the renewable space, that's the stock that I put down as my bad performer. Interesting you should mention it, and probably exactly for those reasons you mentioned, chasing yield.
Go for it.
So yeah, my bad performer was Bluefield Solar, and it's been a long-term holding. It's actually one of the first trusts I bought, I think way back in 22, 23. And it's had its time in the sun after the invasion in the Ukraine, and I did top slice it. It went up, but then, as ever, no politics, Henry. I agree, but in this country, if you do well, you get brought back down to earth, and all of a sudden, there was an extra load of tax thrown at these places. A lot of things in the press around the gas price and driving these renewable investments. It all of a sudden became a bad story, and I tried to look through that and hold it. The world is moving to a more renewable place, but the more I learnt about that space and the more you look at the assets, the more you look at the investment, then obviously interest rates, and then the kind of the chase for capital in terms of big spenders in the market. All of a sudden, when they can get 4 or 5% on a bond, these aren't interested anymore. So it was great for a low interest rate environment, and I think just gradually over time it just ebbed away at my confidence, and I sold it midway through the year this year, and it's still drifted down from there. So yeah, it's definitely a space interested in for the reasons on the planet. You want to do the right thing, but I just think the vehicle and the way the subsidies work and the bigger picture, there's until there's some really, really positive news and a really clear direction of travel, I just think these are just going to still drift down.
Unfortunately, I think you could be right. We had such a huge sort of sentiment shift going back to almost pre-lockdown. Yeah, it was all about renewables. It was all about solar and other sort of ways for us to come away from all the ESG stuff. But essentially, it peaked, almost, I'm going to say 22, 23. just as everyone else was deciding that that was a time to get into it almost. And then it's come off since then. And I think, unfortunately, what's happened is that the institutions that were championing ESG have also backed off. You saw the big headlines regarding BP, for instance, and Shell, and all that money that they were going to invest. They've all just quietly stepped back. Some of them loudly have stepped back and said, "Oh, we're not bothering anymore with that."
But isn't that because they can't make money in it? I think a large problem of the fact that so many of these renewable trusts are falling in share prices because the net asset value is declining. And the net asset value is declining not only because the actual technology itself degrades over time, so solar panels wear out, wind turbines wear out, hydropower turbines wear out and have to be replaced. So they're becoming less valuable, they're depreciating. But then, like you say, Andy, you've also got that issue with the fact that governments are stamping down on power prices and driving down the cash returns that you're getting off the assets anyway. So not only is the technology becoming less valuable, you're getting less income off it. Yeah. And that's really quite a dangerous combination, I think, for a company to be in, because I don't see how any of them will reverse that. And I think that's why companies like BP and Shell have kind of gone, actually, this isn't such a great idea.
Yeah, and I think there's some other things in there as well. I think around the bad news story is, the more people start to look at these trusts, they realise things like, hey, if the wind's blowing, but we can't get that electricity onto the grid, then you pay these guys. So you as a taxpayer are subsidising wind farms that are spinning round, and you're actually subsidising to pay back to those wind farms to actually turn the feed off. And that's directly related to the grid. So if the grid, which was designed for a few big power stations, now wants all of these small feed-in, solar farms, whether it's wind, if the grid is not there and it's not able to take this in and manage it in an effective way, then what are you subsidising? And I think that's the question that a lot of people are starting to make. And the way that things work in this country, it gets blown up into, this is anti-renewable. You're saying that the global crisis is bad, or that's not the case. It's this mechanism that's been put in place just doesn't stack up and doesn't make sense. You need to get the grid right. You need to get the software right to manage it, and then all of these assets, all of a sudden, you're not subsidising people to be making electricity, and they're just throwing money at it, not to feed it in. It's bonkers.
I completely agree with you. We got Matthew Gregory who's got a question for you. I hope he's going to keep it short and sweet because we need to move to the next individual. Matt,
no,
go for it, mate.
Comment. When you were mentioning about with Bluefield damaging your confidence, it kind of goes back to something that Peter and Henry talked about in an earlier podcast. Is I think there is a case to be made about if a investment is kind of just worrying on your mind so much, it's kind of damaging your psychology as an investor, and that can have ripples across your wider portfolio. So I think there is a case to sell something if basically it's losing you sleep, as it were. You're going to make more poor decisions because of that. So it is not a nice point. That was all.
No,
it's
absolutely.
A great. Yeah,
that's been
Andy,
a hard-won lesson.
Yeah, and Henry and I have spoken about. I think DGI now has been the bane of contention for us, and others. And Henry and I don't want to talk about that stock anymore. We seem to have talked it to death. But this is learning. It doesn't matter whether you've had 5 years or 25 years, or in my case, going into my, I think 33rd, 34th year next year. It's madness when we sit down going, no, it'll turn around. They've promised this, they've promised that. That chart. It's just ridiculous, and every time you think it's just about to recover, it then goes another leg down, and every time you think it's going to recover, they come out with more bad news. So it doesn't matter whether that yield is 10% or whether the NAV's £1 at £1 each. The stock is telling you it's not believable. And if they can't sell their best assets, what are they going to do with the ones that are poor assets? So but sometimes you just got to go, you know what, lesson learned. Book bought, education told. I'm going to have to move on. Nosebleed, get up and try and fight another day. Right, Andy, thank you ever so much for sharing those two stocks, mate. We're going to go now to my good chum, Danny the Wallace from Manchester.
Hello,
Danny. How you doing, sir? You want to give everybody a little brief overview of who you are, what you're about. We don't need to know you're a trade unionist, mate, but you'll become unpopular then.
Well, I first started invest. I don't have a family background in investing, but to me, investing just looked like a good idea. It just seemed like, well, that's. I always find it interesting what draws people to invest in, because I find all sorts of people come to it with this sort of like, well, why wouldn't you? From all backgrounds. So my first investment was a direct line tracker PEP, some 30 years ago. I don't know, it's a long time ago. And I just chugged away with the investing in the background. And I've lived off my portfolio for about the last 5 years. And the game does change when you're living off your portfolio. Your perspective is different. I tend to invest differently. I'm not one of the cool kids. I'm not one of these that can find a little micro cap thing that goes massive. It doesn't fit me. And it's interesting, Andy's already spoke about psychology, as has Matthew. And it's, for me, investing is trying to figure out your own psychology and what fits with you.
Absolutely.
It's really weird. It's like a psychology test. It really is. So what I like is things that go up nice and steady above the world index. I always use the world index as my foundation, right? So it's got to be above that, and it's got to go upwards. It doesn't really get much more complicated than that. I don't like things that zoom up because they tend to zoom back down again. So I look for nice steady risers. So that's what I go for. So Andy's already thrown it on the table, 33% return. So I was wondering if I could do a different year to this year, if that's all right. That's not fair, is it?
That's not fair. No, we're going to stick to 25, mate. You go for 25, please.
So when I work out my return, that's based on what my pot size was, my overall pot size at the start of the year, what I've spent, and what that percentage increases or not. So it's everything. I don't sort of cherry pick, because I know some people do. So last year was great, because what I like to do is I like to buy US large cap momentum and have a trailing stop loss. And when it comes off the boil, which they nearly always do, I sell, and then I have something else ready to rock and roll, and I'm straight in. And last year worked exactly to plan. It did what it was supposed to do. And then it all changed around October, all went a bit weird, and the stop losses kept pulling everything out. So then I came into this year pretty much well going through January, February. I was horrendously cash, more cash than I'd ever been before, because I was expecting a long ball. It could only go down. I was expecting this long ball, and I was going to plow back in again. So I'd already put my plan together of how I was going to go back in. And because when that happens, it's so odd, and firing back into positions is difficult, I was going to use world trackers as my re-entry. So April, brilliant, down it goes, exactly as I want. But instead of taking a long bowl, it bounced pretty much straight back in again. So through April, I was firing back in, boom, boom, boom. And then it's like throwing a blanket over the lot. And then I look for what runs out, and then I take a ride on those. But for me, I was struggling to find stuff. So I've had a pretty flat year. I've had a pretty lousy, well, flat. Last year, I was at 35%, which was great. So the psychology there was to not lose rather than win, because I've seen big wins followed by big losses. And a lot of what I do is about not losing. So if I make a win, I want to keep that win. I want to lock it in and not lose it again. So a couple of performers from this year. Like I say, ideally, I want US large cap growth. I want to ride that momentum. So McKesson MCK, they work well for me this year. Okay. But I've sold them. And I like to try, what I try to do is remain absolutely true to myself and not be influenced by other people. So McKesson went up lovely all year, and then it came off the boil. So it came off the boil, and whether I think it's good, bad, or indifferent, if the chart says it's come off, it's gone. So that went. So McKesson was fine, right? But I mean, like, so last year I had over 40 stocks in play. This year it's been like 10. It's been grim. I've really struggled this year. So I've not adapted well. Gold, silver, I've not played those. I should have done. That was an error. They don't really appeal to me for whatever reason. So that needs to change. Then another one I've had and got rid of, and it's a fantastic example, was Warpaint W7L. So if you go back, say, 2 years on that chart, it shows a better story for this purpose. So it went up nicely, great, came off the boil, sold, and I never sell easy. I'm always really gutted. And you get this attachment nonsense, which makes no sense. I'm always disappointed when I sell. So it went up nicely, sold, took a drop, means I'm brilliant, got going again, here we go, all looking good, came off the boil again. So I sold it again. So I don't mind buying and selling the same stock. I'll do that quite happily. But with W7L, when it came off that second time, I put a note on my spreadsheet, do not buy this again. And then it went down, and because you've got to really keep yourself in check. And then it went down and down and down and down, you know. And I've got friends. I'm a big fan of investor groups. Go to a lot of investor groups, run lots of investor groups. I'm on the investor groups, and you have to absorb the ideas from the others, but still maintain your true perspective, which is really hard. It's all psychology, and it's all about wrestling yourself. Again, Matthew mentioned the sleepless nights. I mean, it's crazy, isn't it? What kept you up last night? Oh, I was thinking about W7L. You know, like you're a tragedy. What's wrong with you? But this is what it's all about. It's all about understanding yourself, gathering information from others, but making that decision true to you, which is really hard. So now we're in no chances of Santa Rally this year, because we talk about politics, we talk about UK politics so far. Global politics is mental. So from my perspective, trying to figure out what's going on now, I mean, all of a sudden, Donald Trump sort of said, we're not friends with you anymore. I'm like, well, we're kind of family, you know, what are you doing to us? So the whole global politics thing is off the scale. I've not seen the world this peculiar for a very long time. And it takes us back to the 80s, where there was doing public announcements on how to build a nuclear bomb shelter out of an old door and some cushions off your settee. You know, we're back to that again. So moving ahead, I'm currently very, very cash. I'm very nervous. And I would need to see some kind of global political stability, because I tend to think on a more of a global view. And I let the market decide. So if I'm right or wrong, if I have a theory, I don't produce a theory and think this is going to do well, because I just can't think like that. I think from what the charts tell me, right? If the chart says it's all systems go, then I'll have some of that. But if it's all looking a bit weird, and this is the weirdest I've seen it for a while, I'm kind of curious what other people think, but this has got to be weird.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
So that's kind
Before
of
we
where
ask everybody else
am.
how they view the markets, Danny, let me interrupt you there. I'm interested. You say that the charts tell you when to enter the market and when not to enter the market, and when to leave a position that you've got. what's charting analytical sort of metrics are you using for your entry point? And then same again, when you say it's gone off the boil, what analysis are you using charting wise, you know, via whichever platform? I'm hoping that you say it's ShareScope. Are you using for it to say, this is my point now, that's a nice base, nice bowl that you've used, whatever. I'm entering now. Politics have gone quiet on this one. I'm going in. And also when it goes off the boil, what technical analysis are you using?
Well, I kind of do everything in reverse. So I put more emphasis on the sell than the buy.
Okay.
Because to me, you make more money on selling well than buying well.
Absolutely.
It's the sell, the amount of people I see hanging on. Dot Digital springs to mind. That did brilliant. Came all the way back down. Again, Warpaint, that's all the way back down. I remember years ago, JPMorgan China, right? It was fantastic, went all the way up. And I remember selling that, and that same time, I was on a meeting that night on the day I'd sold. And there was a guy in the meeting who I have loads of respect for. And he's saying, yeah, but you can't sell China, can you? And you're thinking, oh, I've done that today, actually. So it's the sell that matters more to me. And it's not very complex. What I do is I do a trailing stop loss. So I follow it up. And as soon as that comes back down, 10% is usually my
10%.
guide.
10%.
I use
Okay.
10% as a guide. And at 10%, I take a look and I see what's going on. I don't automatically sell because sometimes it's just a weird glitch. So at 10%, I'm usually out. And sometimes you can see it's heading towards, sometimes you can see it's on its way down.
I really
Danny,
like that, Danny. I mean, one of the companies I'm going to talk about a bit later on, if I'd taken your advice, I'd have more money in my pocket right now than I've currently got. And it's just like you say, you can ride something on the way up and think, oh, you know what, I'm a genius. This has been going 2 years. It'll keep going. And all of a sudden sentiment shifts. And next thing you know, it almost can't get out the way from falling. You're thinking, well, it might come back. And that's when that narrative of it might come back. You're just hoping. You've got no evidence for it coming back. It's just going wrong. So I really, really like that trailing stop loss idea.
Well, people are like, it's like holding on to an anchor that's sinking all the way to the bottom, and they hang on and hang on, and it makes no sense. I'd rather be wrong with money than wrong without it. You know.
Love that. That's stolen, Danny. That's stolen. That one.
You can have that. I'll send an invoice.
That as a tattoo, mate.
So I really focus on the sell. The sell to me is where it's all at. Lock in that profit. Don't follow it all the way down. And I hear people say things like, oh, well, I'm a long-term investor, which is the weakest excuse there is for I've hung on to something that I should have sold years ago. If there's something else doing better, that's where you need to be. You know, so that's my view.
Okay.
Like, as regards,
Andy's going to ask you a quick question, mate. Go, Andy.
Yeah, Danny, you mentioned the stop loss there. So, but not automatically kicking in. So, is that when you say stop loss? Is that then an automated message that comes to you to say this stock has dropped 10%? So, if you're out and about, you can have a quick look and think, oh my God, what's happening?
Yeah. So you get an email through. You then get a cold sweat and a chill down your spine.
Yeah.
And you make your excuses and you run off, and then you decide what you're going to do. It's not absolutely guaranteed that you sell. There could be some glitch. You have to have a look at it. I don't like to automatically sell. I know there are plenty of people that do, and they just automate that process straight out. I like to have a quick look first. I like to deliberate, but I much prefer, because I can always buy it back, you know, and the cost of selling it compared to the cost of going all the way down to the bottom of the ocean, just sell it. Have a think about it. Go back up again. Sometimes I get it wrong, but I'd rather those rungs where I've missed out on it going up don't hurt as much as those rungs where it has gone all the way down. And there's loads of them that have gone all the way down, and some real big hitters, So that's the way I tend to approach it. So I'm going into 26, much more cash than I would normally have, and with quite a lot of nerves. And I would really like to see this global political story go somewhere nice for a change, because it's never been this bonkers for ages.
I think that's a sentiment we would all like, mate. We'd like to have the geopolitical side of it to be less uncertain, less volatile, and more pockets of things happening all over the place. I think that's what we'd all like. I've got Lewis here. I've kept it's gone off the screen now. Maybe we'll go to Lewis next.
JPMorgan China Growth Fund.
Yeah, he's talking about that. So Henry, we're going to skip you for the time being because I'm conscious of the time, and we might get back to you later on. We're going to go to Lewis. And you can mention something there regarding what you were talking about, JCGI, Lewis.
Sure.
Just a brief introduction, please, for our audience. Your investing style, and then 2 stocks. And again, Danny, thank you ever so much for sharing those insights, mate. Really, really good. I've tried to remember what you've said there, but I'm going to go back and listen to it again. That little bit there, that little segue, I'm going to steal that and put it on a T-shirt and sell it, raise money for charity, maybe even. Right. Thank you, sir. Over to you, Lewis.
Thank you, Peter, and thank you for the invite. It's an absolute pleasure to be here. As they say, long-time listener, first-time caller. So it's an absolute joy to be here and to share some of my experience. And I think I could be a lot more I have much less experience than Danny. And I'm in a different stage, I guess, of my journey, if you like. So as Peter alluded to at the beginning, I am in pharmaceuticals. I've been in pharmaceuticals my whole career for about 20 years. And my journey, I guess you could say, started in my late 20s when I started paying more attention to my, I think I changed company, and they do that thing where they send you a pension package, like, oh, we've set you up. And I don't know what clicked, but something just kind of went inside my head of I should probably, all this money in my payslip is going to this every month. I should sort of take a keener interest. Clearly my 20s were far more exciting. And and then ever since then, it was very scattergun, probably like a lot of people here, no real strategy at all. Bought things, sold things, had no patience. I'm not going to tell you what I owned, because I've sold some real things that 10x, 20x, 50x, and I cry now. And I think, why did I sell that in my impatience in my youth? But anyway, and I think as I've sort of matured and on my journey through life and career, I think I'm at that stage now where I'm much more confident in my choices and my portfolio. I'm much less tinkering around. Unlike Danny, I'm much more in my accumulation phase now. So I'm not, so it's all about, there is significant cash, I guess, on the sidelines, but a lot of it is in equities. I've picked an investment fund I'd like to share, actually, but I think it's less sort of tinkering now. My strategy is, is growth and a bit of, with dividends where possible. It is that nice sort of pocket money you sort of get. I don't know why. I know growth and capital growth is really sort of what we all want, but there's something about getting dividends from your insurers, like good old M&G and stuff, who I don't know why, it's very sort of fulfilling. Anyway, what I'd like to share is my sort of positive for the year is the Blue Whale investment fund. And I know you are a friend of Stephen Yu, who manages that fund. I think he was on your recent show in September or October. And I thought it's just worth saying, because obviously I think it just goes we take it for granted that we invest in sort of low cost tracker ETFs. I mean, I'm not going to sort of patronize the audience. I think, that's kind of for granted. And in a lot of my portfolio, that was one of my big learns early in my 30s, was you know, get the low cost tracker. You know, it's just sort of play it steady, invest in the world, you know, all of that good stuff, track the market. But I think I found Stephen and the Blue Whale fund a few years ago, I think late 22. So I don't know if you want to zoom out to sort of 3 years. His 1 year growth is very good, but 3 years it's very good actually. And it's I've always been a bit. I think a lot of active managers get a lot of hate because I think it's difficult. They do have a tricky job. I was watching an interview with Terry Smith the other day as well. I think he was defending his record of like a few years of underperformance. So it's a kind of, you know, I mean, I'm not getting the violins out. They're probably compensated quite well, but it's still a tough job and probably tougher than what I do. However, he's got a very interesting portfolio at Blue Whale, you know, and it's got a, you know, an interesting sort of top 10 exposure of AI, semiconductors, a couple of luxury brands in there. Just looking at it again now, a gold miner, Uber as well. So, you know, companies that I think as I've gotten older, as I said, I've kind of much less lowered my likelihood of buying individual stocks. The stocks I've got, I've kept from my 30s, but I think it's much more now consolidating into sort of the baskets and the trackers and the funds now with active managers. So I'll open it up to any questions or comments you have on that.
I had Stephen Yu at the Investor Summit in August, and he presented there, and I also did a one-to-one on the stage with Stephen. And the style and the philosophy behind Blue Whale is deep concentrated research, but it's not just Stephen making the decisions. The brilliant thing about the philosophy of Blue Whale is that it's a team thing. It's not about, okay, I'm making the number one decision on whether we're going to go for. It's researched individually. They bring it to the team, and then it's a consensus, almost a consensus viewpoint on, are we all going with this? Are we happy with this? Everyone is absolutely hammering that one individual that's brought that stock until they all agree that this is the one we're going to go for. And they're looking for the momentum and growth of this stock for the next 3 years as a minimum, almost. So if they're getting there early enough, like they did with Nvidia and others, yeah, they're ahead of the curve because they're looking at what the catalyst and momentum could be regarding revenue and growth regarding that particular stock. You know, they're looking that far ahead. They're not looking for what will happen in the next quarter or the quarter after that. They're looking at what, you know, this is what structurally changed regarding this arena. Who are the absolute number one, if possible, can we buy at not necessarily the cheapest price either? Which one's going to be outperform everybody? If you listen to any interviews I've done with Stephen, and I've done a few now, and also interviews he's done about other people, his conversation is mainly about outperformance. Yeah. So he's looking for the best in class regarding what he's doing. So you talked about some of the stocks that he's got there. Obviously, he's got Nvidia, but he's got Flutter. So you're thinking, well, you know, I think a few years ago, everyone said, oh, it's a technology fund or trust or whatever entity, investment company. It's very diverse as to what he's got in that portfolio. Yes, he's got a lot of AI and tech, but the fact he's got a gold miner in there now, the fact he's got Uber in there now, and luxury brands as well. And I think until recently, I think he also had a tobacco stock.
Yes, he did. Yeah.
I think Philip Morris, I think, was in there when I was speaking
you're right.
before.
You're right.
So it's about what is best and what's strategically, regardless of what's going on. I know Danny and I and others have already spoken about the geopolitical shenanigans that's going on all over the place. What stocks can I pick over a 3-year period that I don't have to be worried about what geopolitics is of the day? Yeah, so great call picking that back in late 2022. It's done well. It should continue to do well. There's all this argument, and Henry and I have spoken about it on the pod as well, about this financial engineering and, you know, all this loopy stuff that where all the money seems to be going backwards and forwards into the same sort of hands, you know, OpenAI, and then everything else is going in through Nvidia and going in through Broadcom and so on and so on and so forth. That domino effect, if it ever happens, could be immense for anybody that's got exposure to too many tech-related stocks. And even the stocks that are not tech-related or AI-related could be impacted by the withdrawal from the markets when people panic. But I think, and I hope for Blue Whale's sake and everybody else that's involved in that space, that the strategy is one of planning, and further planning, and having the strategy to cope with any fallout regarding that domino and that we see. And Henry's got a viewpoint on this as well, so we'll go to Henry regarding it. But it's a company that I like. They're fantastic individuals. I get to meet with them at least a couple of times a year, and they never take any of my ideas, by the way. But I always get an opportunity to challenge them and question them. And they've got a fantastic team of young individuals that are hungry for success as well. Henry?
Yeah, I mean, I'd echo all of that, to be honest. I think it's a really great fund, Lewis. I'm a little bit, biased, I suppose you could say, as Stephen's somebody that I've seen live, and I've listened to a lot of interviews with him. And fund managers, they're always doing a sales job, aren't they? So they're always talking about the good and downplaying the bad. But I think the track record of Blue Whale lives up to the sales pitch, if I'm honest. And like Peter says, one of the things that really struck out to me was the fact that Stephen really genuinely seems to have this collaborative mindset with his team. It's not about, okay, you started this year, I'm not going to listen to you till you've done your time. You could have started yesterday. If you come in with a good idea or a valid criticism, he will genuinely sit and listen. And you've got the opportunity to persuade him to change his tact or to bring new ideas to him. And I think that's why, over such a long period of time, they have outperformed and done so well. And it's interesting, if you go back to, you can see on the chart, there's that huge drop off when tech stocks were collapsing. They were looking 3, 4, 5 years down the line. I remember talking to him at the time, and he was saying, I'm not particularly worried about what happens in the next 6 months, the next 9 months. I'm looking years in the future. Yeah, we've got a wobble. It'll bounce back. People just need to hold the nerve. And sure enough, you look at that recovery, and it's just spectacular. So I think you've made a wise decision putting a little bit of money with Blue Whale.
Yeah, agreed. Lewis, can I ask you a quick question about that? When you say you started investing in it in 2022, was that an initial position you took and then you've added to it incrementally since, or did you put one lump in and then stayed?
Yeah, it was it was a lump, and then because it was like, when you sort of find a new guy, you're not sure, but as his conviction has grown, and as you said, Henry, I think the more you sort of start to read more about him, and he's kind of like his conviction and his calm demeanor sort of gave me confidence to keep sort of dollar cost averaging in over the coming years, really. So and as you say, Pete, I mean, with when you're working and you've got a job, I mean, I love following the financial news and listening and watching the podcast. I don't have the time to do that rigor like he does, and certain people on this call do. So it's more than happy to outsource that to people like that. But so I've got the opposite problem of Danny, which is I'm not too worried about the selling right now. It's the where do I keep putting my money in, and what's like I said, it's that sort of confidence in your portfolio to sort of try not to tinker and to sort of just stick with the strategy and just keep going for it, really. It's just in the interest of time, I'll just move to my stinker, if you like. And I think we don't need to spend too much time on it, because I think you talked about it a couple of weeks ago with the news of that merger, which is now not happening around and I don't know if you want to comment on it, but you probably know more about it than I do, but the Renewable Infrastructure Group, TRIG, not to sort of labour the point, because I think Andy talked about it as well with energy and renewables. Again, that's very much a heart overhead decision about the belief in clean energy, and just sort of supporting that, with capital. But clearly, there's something, I don't know, other stuff is going on in the world. But I haven't sold it. Don't really know what to, it's like, I don't know. I've got no price point in my mind where I would. Maybe I should think of that. Maybe that's advice for the call, but I haven't really. So yeah, that's probably my that's where
I will throw this
I'd leave
straight
it.
in then, right? And take away all the noise regarding the actual situation between the two companies where both management companies wanted to merge, and then quickly X, Y, and Z, 3 or 4 different fund managers who are invested in those two entities went, this is not a marriage made in heaven. Why are you doing it? It makes no sense, you know. And then within a few days, they've all gone and walked away. Hickle's shares have gone up. TRIG's carried on going down.
Yeah.
The big question, you're going into a room on your own now, Lewis, right? Given the share price right now, you've got the same amount of money that you had when you first bought it, yeah, that you could probably go and buy TRIG again tomorrow. Would you buy it tomorrow?
That's a very good question, Peter.
And sometimes that's the one question
And
you need
that's
to
a very
ask.
good question.
You don't need to do all of that other stuff.
Yeah.
Yeah. What's this? What's that? Oh, it's still paying me a dividend, you know, because you can look at the total returns for TRIG over the past 5 years. And I don't know what that number is, but it's likely that you have been paying the management to live in luxury and to stay on their yachts.
Yeah.
I don't know.
Yeah.
Right.
Yeah.
So what I'm saying to you is, regardless of the amount of money that you put in 2 or 3 years ago or a year ago, if you had that same money again, yeah, ignore all the noise about if this, that, and the other, and it's going to be a bounce back, and Sabra are going to come and do that, and Sabra have bought more. Would you buy it now, Lewis? You know, would you put your hard-earned money in again?
Yeah,
good question. Same level at this lower price? And that sometimes just gives you the answer.
Well, that's the opportunity.
Your heart and head will just go, Lewis, this is what you need to do.
The other side of that I'd say, and I've stolen this from someone else. This isn't an original.
It's probably stolen from me, Henry. You know that.
The other thing I would say, let's say it dropped 10% from here, would you sell? Probably not. Let's say it drops 15%, would you sell? Maybe. If it dropped 20% tomorrow, would you sell? Yeah, you probably would. So if you sell it for 20% tomorrow, why wait 6 months and see if it drops 20%?
Yeah. It just feels very I just don't like my decisions to be knee-jerk reactions.
No.
That's the thing.
I'm identical, you know, in that mindset. I'm so slow to sell positions.
Yeah.
And sometimes, you know, sometimes they do bounce back, they do recover, and sometimes you do have to give them that patience. More often than not, and it may well be because of the stocks I've selected that have not done well. More often than not, if they're not doing well, they don't tend to recover. I've been investing nearly 10 years. In all that time, I've probably only got 3 or 4 that I've sold that I've really regretted selling after I sold them. All the rest I've gone, no, I was happy to move on.
I think also, Lewis, as well, we go back to the conversation about this is the renewals space, renewables space, right? And that sentiment has shifted, right? When you're in your 20s and you're looking at the tech stocks and so on and so forth that you had and you sold, and you're going back and going, oh, that was a 10 bagger and now it's gone so much higher. I will say this boldly and on heart, that's not going to be TRIG. It's not going to suddenly go to a premium of NAV and over the next 5-10 years go up 5, 10, 15-fold for you. I think, hand on heart, that there will be some activism in that stock over the next 6 to 12 months, right? By whomever, and the share price could go up. But equally, there is a risk that it just drifts because who is the suitor that wants to buy renewables right now? Yeah, it's a buyer's market, but nobody wants to buy renewables. Yeah, or your NAV is that, or you think that's worth 100 million quid. We'll offer you 50 for it. They'll probably accept that 50 for it, or that 75. Will it be on par? Will it be the 100 that they want? Very unlikely. When I have this conversation with lots of people, you've said that your discount to NAV is 17%. Okay. There is very few of them have coming back and saying, we've sold that at a premium to 17%. Yeah. It's sometimes at 17% discount, but it's usually a lot lower. Why? Why are you selling it at that? And if you can sell something at NAV, why are you selling at a discount? Because they're actually selling off the best, the gems of the assets that they've got. They're having to sell them first, and it should be reverse. You should get rid of the worst ones that you've got to try and carry on getting the income from the best assets. Was actually selling off the best, and if you sell off the best first, what hope is there to actually get the NAV back? So that would only be my argument. But
thank you.
When your wife's not in, you sat home one evening, no one else in the house, just turn the lights down low and have a little ponder, thinking man style, and go, Lewis, would you buy? And have that conversation, mate.
Yeah, will do, boss. Thank you.
You're very welcome. You're very
appreciate it. Thank you.
I know you're not on Twitter much anymore, but have a look at some of the conversations that have been had regarding TRIG. Quoted data have written some articles as well regarding it, and you'll see some other articles via I think CityWire and also the AIC with Annabelle Brodie-Smith and her team. Okay. And hopefully then you get a consensus, but it's your decision, it's your money. Have a think about it. And you said about being patient. I'm going to carry on just briefly about this. That chart there in front of you, the 1 year chart, shows the run up when Saba and Co and all the other activism started back in January of this year, and that was the push up. Oh, everyone's going to get involved. It's such a wide discount, and it went up, and then the bid, and then it's rolled over since July, August time. Yeah. So you've been patient with that from March when it hit the low. Yeah, you saw it go up again by X amount of percent, 15, 20%, to the high of July, August time. And then it's been drifting since August. And now there's no bid. There should have been a relief rally on that no bid, but the relief rally happened to Hickle because they backed out. Yeah, and Saba doesn't always get it right. They've doubled down, but they don't always get it right. Okay.
Thank you. Yeah.
You're very welcome.
Yeah, appreciate it.
No, you're very welcome, mate. And basically, I'll say the last thing I'll say on it as well is that this person here doesn't always get it right. Got many losers to talk about as well. Yes, no one needs to remind me of my many losers. Right. Okay, we're going to go to Matthew Gregory. Matthew, introduce yourself, sir. Thank you so much for that, Lewis. Really appreciate you sharing those, mate. Much appreciated. Matthew, you're going to keep it short and sweet for me. Are you going to talk about Games Workshop?
I may possibly be talking about.
Oh my word! No, we don't need to do that.
What a hero!
Let's jump to the next person. All right, come on, Matthew.
I'm Matthew Gregory. I'm a software engineer in the games industry. I kind of feel like I'm turning into Peter's house-trained nerd, as it were. So I've been investing off and on since the early 2000s, starting off with index funds, and then for the last kind of 10, 15 years, bumbling around slowly, very, very slowly, getting better at actually selecting my own shares with a lot of prangs along the way. So that's kind of who I am, and I've got a blog as well, which is the search for the idiotic investor, and that's on WordPress.
For those of you that don't know, every time I see Matthew at an event, he always pulls out from his bag some fascinating book on nuclear physics or geopolitics or Chinese history from the 12th century. He's incredibly well read. And so his blog articles, where mine are mostly investing in politics and sort of current affairs, Matthew will go down some tangent on some aspect of life or history that you know nothing about. Absolutely fascinating. So do go and have a look.
Okay, I'd agree with that as well. So Matt, go with your first stock, please. Tell us about that.
Yeah, so this is my one that's done well this year. This is Games Workshop. I've held this for a couple of years now. So as you can see, the end of the year was definitely a good one. So GameSport's been on an interesting journey over the last year. As at the back end of last year, it got promoted from the FTSE 250 up to the FTSE 100. And then just recently, Jefferies put out it re-rated it up to, I think it was £180, and then the following day, Games Workshop gave their trading update, which was actually better than Jeffrey's target was. So Jeffrey's had to then re-update the update. And I think it's now sat on, Jeffrey's has got it on a target of over £200 now, which is a bit of a surprising level of upgrading. In terms of financials, it's a real powerhouse in terms of returns and quality of earnings. If you want to flick over to the financials, we have a quick overview of that. If you look at the quality metrics at the bottom, it's a cash machine essentially. And not only has it got high returns, it's got high operating profits. It's just doing all the numbers. It was interesting. I was at the AIC the year, and I thought Henry was going to have to be my security guard to escort me out of the room. As when we were there talking with Nick Train's presentation, and he'd gone through all the list of companies, and he'd mentioned various metrics. I thought, well, Games Workshop isn't fitting in there. I wonder why he hasn't mentioned it. So I was actually hoping he'd give me the bear case for Games Workshop, and I asked, what about Games Workshop? And the sentiment from the room wasn't particularly positive around Games Workshop, but actually Nick Train did actually say, and I actually kind of made the news accidentally on this, is I outed that he'd actually begun buying into Games Workshop, and he classified it as one of the diamonds in the UK. Wow. So Finsbury's update on the 3rd of December actually says that they've now actually disclosed the holding in Games Workshop. But yeah,
I think it made the news about 2 days, maybe not even 2 days after you asked that question. It was picked up by, it was either the This Is Money or the FT. It was one or the other.
Brilliant.
Yeah. And so, this has been an interesting year for me, as I managed to do something I've never done before with this. So Games Workshop had, earlier on in the year, kind of actually put out their own expectation management, where they said, look, guys, we're not going to do as well as we did last year, because they've come off the back of an amazing IP success of Space Marine 2, which, if you're into your games, is a really, really good game. But they hit about £65. They were stuck there. So I thought, I'm going to top slice some of this. And that was in the July. And I kept the cash to one side because I'd given myself a rough entry target of about 130 to 135 is where I'd feel comfortable getting back in again. And it kind of drifted down. And then it kind of petered out about 140, in the 140 range. And I decided, because there's something that Peter's mentioned before, is like having that target fixation of, once it gets to my target, I'm going to buy this. I thought, it's almost there, it's not quite. I'm going to put half of my money back into Games Workshop. So I bought in the beginning of October at about the 144 point. And then it began to go back up again. I thought, okay, I'm going to miss this. So I put my money in again. I put the rest of my money back in again at 151. And then, it's just suddenly re-rated, and it's gone bananas, essentially. That's not a trick I'm going to recommend repeating, as that could have gone very, very wrong. So I will classify myself as being quite fortunate with that. It didn't hold for much longer, or else I had to have bought those back at a lot more money. Yeah, one thing that's also it's been brilliant. One I'm still holding. I'm quite bullish about next year. This will actually please Henry. They've just announced Total War Warhammer 40K.
Yeah, not that I'm at all excited about that.
And they've also got another game out next year, which is Dawn of War 4, and that's very much got a lot of buzz for next year. So next year might be another good IP year for Games Workshop. The one thing I would push to the back of people's minds is the Amazon deal. I really wouldn't expect anything from there until the earliest of late 2027, maybe 2028, because of just the turnaround times of making high budget TV are massive. In terms of getting out of that. So yeah, that's kind of Games Workshop. I think it's the one thing I can say is that it's brilliant, but I think it does have an upper limit in terms of size. It's never going to be the UK's Marvel, I don't think, to be honest. But I would love to be proved wrong.
Okay. No, thank you for that, mate. I'm going to go to Lewis and then to Paul Edenbrow, who's got a couple of questions for you regarding Games Workshop. But I did note that Danny said Nick Train can't be that good because he also has bought Manchester United shares. But that's nothing to say because Danny is, I believe, a Manchester City fan, so he hates all things to do with Man U. What can we say? Right, Lewis, you had a question for Matthew?
Yes, thank you, Peter. Very quick question, Matthew. And to a naive person like myself, but when you see in America the share prices go up dramatically, the first chance they get, they stock split, and they always use that excuse to encourage more investors. Is this something that Games Workshop have ever considered?
Never split the stock.
And never split the stock. Is that just like part of their rule, or is it? It's because I don't know if UK companies never do it much, do they? But they never reach £200 a share. So I just wondered if this is something they might.
There's never been any mention of it, so it might hit a point where they get too expensive. But then again, ask Warren Buffett if he's ever split his stock.
Yeah, true.
Okay, Paul, what was your question, Paul Edenbrow, please?
Just really a statement, actually. I think it's quite interesting. I know they're very, very different companies and very, very different market caps, but Games Workshop and Warpaint that was mentioned earlier both have, or Games Workshop certainly now have a really, really high PE ratio, 32, I think, according to ShareScope, and predicted to get even higher next year. And that's really put me off investing in Games Workshop, really, that high PE ratio. But I think it just shows you that quality shines through eventually. We all know that Games Workshop is a fantastically run company and room for growth and expansion. So probably justifies that high PE.
Yeah, I mean, there's two things actually I forgot to pick up on that I've actually written down in my notes. Is I was having a look through the non-executive directors last night, and actually this year they've hired a new non-executive director who for 20 years worked at Lego, and probably the big thing which caught my eye is he was the president of Lego's Asia Pacific region, and he has experience of basically opening new markets such as China and India. And that's kind of actually the activity breakdown here is one of the key things I think people forget about Games Workshop is actually most of its revenue now is generated from outside of the UK. The other thing is that it's massively under-researched. If you look at any other big name FTSE 100 companies, you're going to get like about 15 to 20 brokers covering it. Games Workshop has 3. That's all it has in terms of research. It's amazingly under-researched.
Absolutely, and that's been the case. I think because of that, it's been able to build up quite a cult status regarding retail investors. So they've been the ones that primarily were the catalyst for that re-rating about 4 years ago, and now the institutions, well, I say now, gradually over the past 5 years or so, the institutions have been adding and building positions, and then some of the larger, well-known institutional investors, fund managers, have also been buying it who are highly regarded by the retail investors, and that's been a catalyst. But they've also delivered the results as well. So, you know, if they're going to be, you know, a bit of a cash cow and with a ROSH of what was it, 83.4 or something like that, which is ridiculous, by the way. So, you know, they're going to be able to throw cash off and produce a fantastic, you know, compounding return because they've not only given you dividends, but special dividends, and they're outperforming, you know, the other stocks. I'll go back to your comment, Paul, and this is from was my number one book, but is now my number two book. But this is the book that changed my investing perspective from many, many, many years ago. And the book is by William J. O'Neill. Okay. And the book's name is How to Make Money in Stocks, a Winning System in Good and Bad or Bad Times. Okay. And this is the quote that will change everything for you. The best performing stocks in history have been stocks trading at a much higher PE than the market. And that fits with Games Workshop. Less so now with W7L because they seem to have peaked and they've got tariffs hitting them hard left, right, and centre. Henry and I spoke about Warpaint a couple of weeks back. I think if the tariffs start to drop off and all the rest, and I mentioned this on the pod, it could be a catalyst for a re-rating for them. But it seems to have lots of headwinds against them. But an IPE should not be a detriment to outperformance, as we've seen with Nvidia and all of the high PE tech stocks. Henry and I have lampooned and battered Palantir, and you know I think Lewis has that in his portfolio exposure to it. Has carried on going higher, so it's not a detriment to the stock or any stock if the management can deliver on that rating and deliver profitability. So yeah, so all good. Thank you for sharing, Games Workshop, Matt.
Just in there, Peter.
And you kept it short and succinct as well, mate. What's your next stock, please?
2 quick metrics can you pop up for me is operating profit and cash conversion in the thing. I think those are two kind of underappreciated metrics. So operating margins, sorry.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk for further details and subscribe to the investing and trading analysis and data you need.
Just in a little note there from Henry, he's got miniatures in his cupboard. I thought he was going to say miniatures somewhere else, but we're going to try to keep this a PG podcast. So,
what's the other metric you wanted, Matt?
That wasn't low blow.
Cash conversion.
Of course. Conversion.
Yeah, top one.
I'm just going to get those on the columns for you to start with.
Yeah. So basically, it's those two metrics. Yeah, 42.3% operating margin and a cash conversion of 99.8. So,
wowza!
Yeah,
that is. I've never seen that metric. Crikey! If I'd seen that mix a few years ago, maybe I've always been a bit, you know, on the cautious side of chasing, you know, what essentially is a company that at the time when I first looked at it, produces miniatures. Anyway, Danny's got his hands raised. He's got a quick question for you, I think, regarding this, and then we're going to ask you for your second stock. I'm conscious of the time we've run so far.
Just in respect to Games Workshop, I have been to the AGM there. They run a proper AGM in their factory, and afterwards you can wander around the place, or I did. Nobody arrested me or anything. You get a really good feel for it, and the CEO is superb, and he'll take question after question after question. And they kind of run their own race. They're not really interested in pumping share price. They approach it from doing a good job well. And if that means the share price goes up, then so be it. really good approach. And if you can ever get to the AGM, it's well worthwhile. As I say, it's a proper one, not doing any digital nonsense. So, just a comment.
No, it's good. That's a good point. Have you never attended one then, Matthew?
No, I haven't. I've never attended any AGM, so it's something I think I do want to do, and also it gives me a chance to wander around Warhammer World as well, which I highly recommend.
I think, mate, if you attended one of them in Nottingham at their AGMs, they probably know more about you than you know about them. Be like, you're the chap that we see on every single video. You're the chap that's always talking. Yeah, they'll probably give you as much free stuff as you want, mate. You know, doing the PR for them. Brilliant stuff, mate.
When I last went afterwards, they've got a great big hall, and all these guys were coming in with their trolleys full of all this stuff, and they're all setting up on the tables as we were leaving, because they have like this big gaming hall, and they set up, and these guys are there for the whole week. It's well worth seeing. It's well worth a visit.
Plus, it's got the added benefit of being in Nottingham, which, as we all agree, is the best city in the country.
No bias from you there. Okay, Matthew, your second stop, please. The one that didn't do so well, or not fair for you.
And you want to look at the share price for this one?
Adobe, one of the few tech stocks that's not done so well in the US.
Yeah. So
why has it not done so well in comparison to the others then?
So it's been on the receiving end of two things. Yes, AI fear, Andy.
Yeah, that's from Andy. Yeah.
So thanks, Adobe does have its own generative AI suite in terms of, I think it's called Firefly, I believe. So they are doing it in that space, but they're not bringing the numbers on at the rate that people want. Their growth rate is now in the high single digits. So for a tech stock, that's pretty slow. It has grown year on year, but it's just not growing at the rate that people want. And this is one of those ones that I am kicking myself over, because I bought this back in January 2023. So if you want to pop a 3-year chart on, you can then just show how much of a numpty I am. So I bought, so I was buying around there, and I could have sold at the 630 one, and I didn't. I held it until when was it? November of this year. Basically, I was really hoping that it would recover, and the market gave me basically 2 years to turn a profit on that. And in the end, I sold it for a 10% loss. And we were saying earlier on about the dangers of price anchoring and just really hoping it would go back up again. And I learned a really painful lesson with that basically I turned down an 85% gain in exchange for a basically 12.5% loss.
Best thing I would say though, Matt, is that you shouldn't beat yourself up too much, because the beauty of what you did there, going back to January 2026, is that you bought smart. Not sure what the catalyst was, and I know you from historically that you tend to track things for a really good while. But having bought in there, that period of time over that 2 years going towards 2024 tops, it's really hard to see it, because you're in and you're seeing it, and it's a 52-week high, it's a 2-year high. Everyone's talking about AI, and you doing your deep research is saying, haha, there's AI generative stuff in Adobe, so they'll be absolutely fine. And then what you're possibly not seeing is that there's a new competitor over there that are potentially attempting to heat that margin away from Adobe, which I think is exactly what's happened here.
Yeah, I think I mentioned is that
and management, because they're so established and they're so large, are saying, a bit like the Blockbuster sort of scenario with Netflix, don't pay any attention to those little boys over there. We're a multi-billion-pound company. We'll be absolutely fine. And slowly but surely, their margins or some of their revenues have been drifting towards other people.
Yeah, because this is the thing. We've had Figma and Canva have come onto the scene.
Okie dokie.
Adobe tried buying Figma, That deal got nixed. And initially there was a bounce back because I think people thought that Adobe was overpaying for Figma. Actually, I think looking at it now, they were probably underpaying for Figma. But yeah, so that is, and also there's been some issues with Adobe's pricing structure. That's been turning off a lot of customers. So yeah, it's kind of been that gradual decline. I mean, the industry I work in, basically the Adobe Creative Suite is like the only game in town, and for most like enterprise level companies, the Adobe Creative Suite is kind of your one. If you're doing more than just Photoshop stuff, then there's a whole tool chain that Adobe gives you, and the thing that it gives you that nothing else does is cross compatibility. Yeah, that their number one kind of their big ticket one is still Photoshop, and that is what Figma and Canva has been taking off them. And also say they've also made some food mistakes themselves, and yeah, it was a bit of a, it was a definitely, I paid my tuition fee to the market, shall we say, with this one. It was one of the ones where it was actually after listening to one of your podcasts when you said like 10%, I'm really questioning this, and mine, like I was like, okay, I'm at 8%. If this doesn't start going positive, hit 10% loss, I was going, that's it, I'm losing this. Because coming back to the comment earlier on about losing sleep, Adobe was my one that was basically making me lose sleep. I was just watching this bleed money away. So it was better for my mental health essentially to get rid of this, because it was impacting my other decisions.
No, good call. Danny's made some really good points I'd like him to share as well regarding the difficulty with getting these things right. And psychology, as we've spoken about before, but also you're in that space, you're in the tech space, so you've analyzed the company as well. So Danny, what were you going to add to that, mate?
It's always hard. It's like, it's really hard when you find a good company with a good product that somehow doesn't work. And I've seen this happen before, where this guy was talking to me about a product that went into hospitals, and it was a brilliant product, but this product landed between two different sections of the hospital, so neither of them had the purchasing power to buy it. So we had this brilliant product sat between two different buying departments, and it didn't work, even though the product was great. So again, it's really hard when you see a great company, a great product, but it just, for reasons beyond your control, it doesn't work. It's the market that's right, not you, all the time. And
yeah,
I mean, the mental health aspect of it is 100%. You know, I put in the chat that I gave a talk at college recently, and this young lad said, "Oh, aren't you supposed to trade without emotion?" Try it. You just see how you get on. It's really, really hard. It's the most, you know, it's really hard. We're an emotional bunch tonight. We all need a group hug at some point.
That's because we've done investing for a good few years now. We know how difficult it is. This is the reality of investing. You know, the hardest part of investing is not choosing the stock or finding the right metrics. It's this up here. It's the conversations we're having, you know, about the stock and about that hard-earned money that we've invested. And, you know, every single metric was correct, and it was absolutely the right point to buy it. Why is the market now telling me that I've got the decision wrong?
If you ever speak to a boxer, he'll tell you all about his losses.
Everything's right until you get punched in the nose, as Mike Tyson says. But this is the beauty of it. And the crazy thing about it is, right, is that, and this is often the case, right, and I don't want to, you know, add salt to the wounds, Matthew, right, but 99% of the time that I go, and many of you know, I have this conversation so many times, and you see him already smiling and laughing, right? 99% of the time that I go, I am absolute, and I'm banging the table and going, what an idiot I am, right? Banging the table and going, I'm absolutely categorically done. I'm never going to look at that company again, right? And then as soon as I walk away, and he's got I'm not sure if he's going to mention it later on, but the company's name is Anglo-Asian, I think, Anglo-Asian AAZ. And I was like, oh my gosh, it's, geopolitics, everything, companies not telling us the truth, blah, 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 blah. I'm done. And I literally, after about a year and a bit or so, I'd had to stop, was selling it, unbeknownst to me, it was near lows, but it's literally a 2-year low or something like that. I was like, I am absolutely getting out. I'm done. I can't deal with it anymore. And I sold at that point. And I was like, and you feel that weight come off your chest and your shoulder, and you go, that's better. You're just giving yourself a little bit of a wiggle. And Henry pipes up about a couple of hours later. I'm keeping mine, Pete. See you later, mate. Bye-bye. And as the course over the year, the share price settled, the geopolitical noise settled-ish. They came out with some good news. The share price went from about 40p to 50 to 60. I'm sitting there going, oh dear. And I'm going, Pete, you said you can't go back and buy that because you can't. Because my thing is about trusting the management. And in Games Workshop, you've got a fantastic management, blah, 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 blah. They've done it historically. They've kept themselves quite conservative. And I just did not trust the management of AAZ. So I'm watching it go higher and higher and higher. And I had a conversation with Henry one time, and he's like, yeah, still not sure about these geopolitical stuff, Pete. And I went, yeah, neither am I. I'm going to stay out there. I think I'll find another stock that does something similar. And I think he might mention it later on. But I watched it go higher. And what's happened more lately? I had a bid. And I love a takeover, as you all know. And it's gone from sub 40p, and it's just pulled the chart up now. It's at now £2.55. So I think it was Lewis earlier spoke about 6-baggers, 10-baggers, and it's a 6-bagger that I left on the table. But I was like sitting there going, and as it always, I'll go back out and I'll say to people regarding stocks that have done well for them, even if they've done bad for me, I'll congratulate them. And that's what we should do, because investing is so hard. If you're on X, if you're on LinkedIn, if you're on TikTok, if you're on Insta, and someone does well investing in a stock over 3, 4, 5 years, just go on there and say, mate, you know what? Well done. Because it's so bloody hard to hold that stock when it's at its nadir and you're 30% down, 40% down, and everyone's telling you you're an idiot. And the chart is telling you're an idiot. Yeah. And the company is, I'm going to use this loosely because I'm sure they'll be listening to it. They've lied. You know what I mean? So you then back off. Andy, sorry, you've had your hand up for ages. What were you going to say, mate?
Yeah, just a quick question to Matthew around Adobe. Obviously, working in the software space and being obviously very technical and understanding, that side of the business. Do you think that may have played into your kind of psychology on that stock?
It is very possible. As I said, I work in the games industry, so essentially I've always worked around people who use Photoshop. So I've always known it as the #1 digital painting software. But and again, I know people who work in Hollywood, and if they're 3D is a separate space, but in terms of 2D and compositing, there's a lot of stuff that's using Adobe, and a lot of YouTubers, everything on there is Adobe, basically because you've got the video creation works seamlessly with Photoshop. There's just a lot of tools when otherwise you're having to try and find ways of converting between formats, which is quite a difficult thing to do. Not all packages are compatible with one another, and that has always been Adobe's selling point. But as I said, it's I think it's a combination of AI is not doing so well for them, and yeah, the new challengers are doing better, and they really have messed around a lot of their smaller customers with the way that their pricing works now. So they just had a run of bad decisions, essentially.
Yeah, great comments, Matt, and thank you for that. I'm conscious of the time. We're going to go to the last person on this segment. Last but not least, former winner of the Twin Peaks Investing Challenge. We've got Paul Edenbrow, another educator, and I love the fact that Paul has taken the task of actually educating our young people regarding stocks, shares, and investments, something that all of us are very, very passionate about, none more so than Mr. Danny Wallace on this particular pod. So if you've not hooked up with Danny yet, get him to invite you to one of the weekend sort of investment retreats he does online with all these very notable and well-read individuals from all over the country that he speaks to. I'm like, mate, you're from Manchester, what are you doing hanging out with these people? What he does, he hangs out with some highbrow people, mate. Paul, go for it, mate. Which two stocks you want to talk about? Give us a little intro about yourself first as well.
Yeah, hi everyone. Thanks for inviting me on, Peter and Henry. So I'm Paul. I live in Peterborough. Basically, I'm a secondary school teacher. I've been teaching economics and business and finance for nearly 20 years now. I'm probably investing for about 10 of those years with my wages. Essentially, I don't have a particularly big portfolio. I very much enjoy doing the research element and looking into the stocks and reading the business news, which I do a lot with my class on a regular basis. And I'm very passionate about bringing the subject of economics to life, really, which is what I try and do with my students. So yeah, in terms of stocks that have done really well this year for me. I know you mentioned this. I think Henry mentioned it on the pod a couple of weeks ago. One that's done really well over the last 4 or 5 years, actually, that I've held is Serabi Gold. I have to be honest, there's not, I would still class myself very much as a beginner in this, even though I've been doing it 10 years. What is my strategy? Well, I look for companies that are cash generative, not in debt or very close to being out of debt. And on the increase, growing, essentially, revenue growing, PE ratio relatively low, and probably a lot more risky than some of the other shares that people have mentioned tonight. I would suggest that Serabi's got a market cap of 215 million, but as I say, it's been really on the increase over the last 4 or 5 years. It's a Brazilian gold miner, so that comes with risks, of course, in terms of the geopolitical risks with South America. I guess the reason I bought it essentially was pretty straightforward, other than the cash generation. About 3 or 4 years ago, I sort of, as I think we all did, became concerned about the macroeconomic situation around the world, and I just wanted to invest in gold, essentially. And I felt one of the easiest ways to do that was to buy a cash generative miner that seemed at the time to be relatively undervalued, and that's where my research led me to Serabi. And essentially over the last 4 years, it's gone up quite a lot, and I think it's more than doubled this year. So I've been really lucky in that respect. I think there is an element, of course, there's an element of luck here. It's the gold price, as we know, has gone through the roof, and that's obviously given this particular stock a headwind in the last year or so. But I started buying it. I'm a bit lucky here, but I started buying it when it was around 50 pence, and I have sold it and bought it back at various points, or sold some of it at various points. But yeah, it's been a real winner for me, and certainly in 2025, it's been my biggest success story. Lots of cash. It's still growing. As I say, there is risk. There's a risk over a license renewal, which is due in January 2027, and it hasn't actually been confirmed whether the Brazilian government are awarding it to Serabi yet. So that's a huge risk. It's only for one of, I think they've got 2 mines, and it's for one of the 2 mines. But if that is awarded, that license, I think this has got a long way to go still. It's still on a really low PE ratio, pumping out the cash, particularly if gold stays around $4,000 an ounce, which I think there's a really good chance it could go even higher than that. Every time the gold price goes up, of course, it's just adding to that bottom line for Serabi. So I'm quite happy to hold at the moment, even though there is a little bit of a risk coming in January 2027.
No, good shout. Really good stock and company. I love the words that you use there, because Henry's always talking about how to throw away money. A man standing over a hole and just throwing money in it. So the words that you use were cash generative miner, and that's the difference between just plucking for a company that says gold in its name, or says it's a miner that is looking for gold. It's cash generative. It's no longer an explorer, or it might be exploring other mines, but it's got mines that's generating income and revenue for them. What I want to know from you, Paul, if you've got any sort of clue around the approximate-ish sort of all-in sustainable costs, how much of a margin they've got, because Henry and I have spoken about quite a few miners, and some of them over the past 2 years or so, the margins that they're actually turning over regarding per ounce versus their all-in cost has been absolutely phenomenal. And the other thing that's really going to be kicking in, if it continues as well, is that the price of oil and oil-related products for miners is actually coming down. So their margins could increase even further going into 2026 as the barrel of oil goes down. So the sweet spot that gold miners that are producing are in at the moment is ridiculous.
Yeah, absolutely. I think I'm just looking here. The all-in costs are about $1,600 an ounce. So it's quite high, I think, that for a miner, mainly because the mines are underground, which adds a cost to it. But the costs are coming down. And as I say, they're looking to expand their existing mines, and it sort of depends a little bit on this license, but they're looking to expand production. And so, of course, again, if that comes through, then it's just going to add even more to the bottom line. So yeah, at the moment it's about $2,400 an ounce profit.
Yeah, it's not. That's very good. That's very good. That's very, very good. Over 100% on top. No, extremely good, mate. Very well done. Good pick and good performance over the last couple of years as well. As you say, macro conditions, reasonably stable government. He says just before we go into 2026 and something kicks off in Brazil. But yeah, it should be okay. And if you can be quickly to just share us one stock that has not turned out to be gold.
Oh, several. Yeah, Hercules has been one for me. A staffing company, and you'll see that on the chart in a minute when it pops up. Obviously, as you do, I bought when it was quite high and sold near the bottom, and more recently it's had a bit of a recovery. You can see there in the last couple of months I'd sold before that, so I've missed out on that recovery there. But yeah, Hercules, I think it's very much a cyclical business. As I say, it's like a recruitment organisation. Still good numbers, it's still very profitable and cash generative again. But I think firms looking to cut costs, maybe recruitment agencies are the first thing to go, or one of the first things to go if they're looking to cut costs. So I think that's probably had an impact on Hercules.
Yeah, I think the thing for me, and we've spoken about, I think it might have been STEM a little while ago. There was all this uncertainty, wasn't it? And I don't want to get into the politics of it, but we had the big budget, or not so big budget, I think we should call it. And there was all that uncertainty from the summer through to October/November when it was coming up. And I think a lot of that people just held off recruiting, or put things back, or decided we're not going to take on that many people right now until after the budget. So that's that little move you've seen there from late /mid-October to now. It's a question of, could that continue? Has all that uncertainty gone now? And will people start recruiting and spending and adding to their budgets in 2026, or will we in fact be faced with a recession? I think Henry's got a few comments on this, because he is in the business of recruiting and analysing staff and having to deal with management/directorial sort of issues. Anything, Henry, regarding the recruitment side, and also Lewis regarding the pharmaceutical side of it? Any thoughts on that? And also telecoms as well from you, Andy, recruitment-wise. What's happening in that space?
Well, it's an interesting field. I mean, my observation is that it's become incredibly commoditized. So it's easier than ever for AI to churn out CVs.
Yeah.
You've now got AI assistants, which will go and trawl job applications, write the CV for you without ever asking you, and fire them out. And so more and more recruitment agents are getting more and more CVs for more and more job specs. The job specs are also being written by AI. So the whole thing is almost becoming a little bit farcical. And I suspect an awful lot of recruitment agents are suffering as a result of that, because how do you actually find decent candidates? Most people I know that are recruiting are complaining about not being able to find decent staff. But then on the flip side, most candidates I know are complaining that they can't find the roles that they want. And so it's almost as though the entire job market in the UK is completely broken at the minute. And I'm personally pinning quite a lot of that on the door of AI. Do I think long-term recruitment agents are going to still be a thing? I think so. I have always got, far better results from specialist recruitment agents than I have from generic HR departments. And so if you've got names that you like, I'd be tempted to sort of sit tight and see how things shake out. But I suspect in the short to medium term, they could be in for a bit of pain.
Thank you for that, Henry. Lewis, any thoughts regarding the pharmaceutical space, mate? What's happening there recruitment-wise?
Yeah, I mean, I can't comment on Hercules, but I think, in our industry, we've got some specific recruiters who, service that industry from early stage, research, clinical through to the commercial marketing side. I think Henry is bang on. I would say the problem hitting our industry is just the lack of new assets and drugs coming through. And so when you've got less coming through, you've got less need for team builds, less need for sales reps, less need for marketers, less need for commercial capabilities. To be honest, I can't comment on the earlier aspect of the process in terms of clinical and research. I'm more blind to that, to be perfectly honest. But with excuse me, but also with our tough reimbursement environment as well. So NICE, sometimes, again, not to get political, as you say, Peter, but that, is something that bears on the decisions that companies make about not just getting a license, but getting reimbursement, and then whether to even enter the UK market and get reimbursement for the NHS. These are commercial decisions that companies are really sort of agonizing over now, and whether to invest in the UK and build a commercial organization or around a new asset and brand. So it's again, not getting the violins out, but yeah, it's a challenge to recruitment.
Yeah, agreed. Now over to you, Andy, and then we're going to follow with Matthew's comments as well, please. Excuse me one sec. You guys carry on, please.
Yeah, I'd say telco is going through, a bit of a revolution just because of technology. Previously, it was a standalone telecommunications, but what's the split between telecommunications and IT? What's a data center? It's useful for, it's useful. It's critical for whether you class them as telecoms, whether it's IT or just communications in general. I think one of the things that I noticed in the industry, I went to Mobile World Congress about a year ago, and you look at the expertise that's in radio, look at the expertise which is in backhaul, understanding overall network, and a lot of the guys are let's just say a bit more mature. So where's all the youngsters? Where's all the training for young people coming into that industry? I think that's one of the areas that I'd like to see. And I think I saw Vodafone and maybe VMO2 putting out kind of apprenticeships to try and draw some in. But when I was in my early 20s, it was a sexy industry to be in. It was like the Google of its day, and it's not anymore, unfortunately. But as an industry, the technology that's wrapped around it, I've dealt with many changes in terms of looking at data science coming into it, understanding how that performance works, and you've got all of these other industries, and they get AI is going to be a massive change in there. The stuff that you'll be able to do with AI in terms of orchestrating networks. So I think it's an interesting space that I wish more youngsters would look at and given the opportunity to get into it.
I think we've lost Peter there, so I'll step in for a moment. I'd agree with you 100%, Andy. I mean, it is undoubtedly going to change things as we go forward, and I think all of us are seeing how it's changing. In my own field, only in the last 3 months, I've started reviewing AI tools that work in sales. There's a lot of hype, and I think there's going to continue to be a lot of hype because people don't understand the technical applications of it. And so to a layman, it looks very advanced and very impressive. Whereas if you've got some actual industry experience, you can see the holes fairly quickly. But I suspect over time, all of these tools will continue to develop, they'll continue to improve. And I don't see them going away. If you go back to the 90s, people were talking about mobile phones, or why would I ever need one of those? Now we all carry them around. And it was the same with, sort of bank cards. People weren't mad keen on those. Even ATMs, when they first came out, the idea of going to a hole in the wall and taking cash out, people thought they were going to be robbed. How do you know the cash is correct? People didn't want to use them. But then we went through a whole period of time where ATMs became part of public life. And I think, AI is going to go the same way.
Thank you very much, Henry. Thank you, gentlemen. I think we're going to conclude there. I'm going to stop the pod shortly. I just need to make an announcement, if I can be so bold. Thank you all for helping us with this pod and the conversation regarding all the different stocks, the good, bad, and indifferent, which was excellent. We're going to carry on a bit later on with another pod, but I need to talk about the MENPHYS fundraise at this juncture. Henry and I had a target of £5,000 to raise monies for an employability scheme, where we're looking to help young people gain a foothold on the career ladder. And the target was £5,000. We've hit that target, but we're still running the fundraise until the 31st of December / the first week of January. So if you haven't donated yet, please consider doing so. I want to say a big thank you for everybody that's donated thus far. We're sitting at 5,249, and since the last podcast was recorded, we've had a donation from Davey C, and his comments were fantastic podcast. Thanks for another great year. All the best. And that was £20 and £5 gift aid from Davey C. So thank you, Davey C. We've mentioned Blue Whale Capital earlier, and one of the individuals there, a brilliant young man by the name of Edward Malia, has donated £50 plus £12.50 gift aid, and his comments were great work, Pete. I think that should be Pete and Henry, but thank you, Edward. So really appreciated. And then one person who is just chosen to use the initials of DPB, whoever you are, thank you ever so much. Another year of fantastic insights and community building, Pete and Henry. Thanks for giving your time to this project, and all the best for 2026. And that was again £50 and £12.50 gift aid. And then we had Steve G, who donated. Have a great Christmas and New Year, guys. Thanks for your efforts with an entertaining and informative podcast. And that was £30 and £7.50 gift aid, taking us to 5,249 plus the gift aid total as well. So I want to say a big thank you to everyone that's donated to that. And any other comments that you guys want to share regarding the pod, before I just say a big thank you to Paul Hall of ShareScope for doing the technical side of things, and the shares and the screens and the technical and all the different screens that we had to navigate over. What is, just before I go and say this, right, we spoke at the very beginning of this to all the participants, including myself, who was meant to be keeping a rein on things, that we're trying to do all this in 1 hour and be succinct. And we're sitting at 100 minutes and 106 minutes right now for this pod. Whew. Right. Matthew, any passing comments? If you're going to say, just say no. Lewis, anything? No. Great. Danny, anything? No. Great. Paul, anything? Thumbs up from Paul. Andy, thank you for joining us for the first time, and I'm really pleased that you enjoyed it. So thanks for coming on. Got to have a passing word to Paul, who's not said much before we go, and then I'm going to close with a comment from Henry. But guys, thank you ever so much for being on this pod. It's been brilliant. Time has flown by, and really appreciate your insights. So Paul, comments from you, please, mate. Mr. Paul All, sorry.
Thank you, Peter. Thank you, Henry. Thanks for having me on the podcast. Yeah, there's the thing that really resonates with me actually comes from Danny, and it's something really quite simple. Stop loss, removing the emotional connection that we all have to our investments. We know we all have that. Just instilling that bit of discipline, and you learn from that. You learn from when you don't do it, certainly, and you learn from when you do it, because you take your profit. And no, I've fallen foul of this. I've had a plan. You go in, you have a target price in mind. It hits that target price, and for whatever reason, you don't sell because you think, let's just keep holding. Let's see what happens. You learn the hard way. So absolutely, stop loss all the way. I completely agree with Danny on that. so much to learn there about Games Workshop. You might not realise this, but I'm a massive nerd. Dungeons and Dragons and board games and so on. So I'll get involved. I'll have a look at Games Workshop some more.
You hit that well, mate. That's a big. How comes Matthew always gets these disclosures from people? I've known you so long. Matthew's getting disclosure from Nick Trader, now he's getting it from you. Bloody hell. Massive nerd. We know that Henry's a nerd. So thank you for that, Paul. And you're spot on about regarding Danny and what he said as well. Henry, passing comments, mate, before we close, before we hit 2 hours?
Just a huge thank you to everyone that's joined us. For those of you that have been watching on YouTube, you'll have seen we've had ShareScope on the screen with us. Some of you in the audience will know that Paul joined us at the various events we've been at this year. We couldn't do it without him.
Absolutely.
A huge thank you. He makes it look so easy, so effortless. It lets me and Peter just stand up and yammer on. So a huge thank you. A thank you to ShareScope for sponsoring us. A thank you to all of the audience that have donated to MENPHYS this year. A thank you to everybody that's read my blog, that supported me on social media, that supported Peter. A thank you to our audience, because you've all supported each other. But most importantly, a huge thank you to you, Peter, for another excellent year of Twin Peaks podcasting magic.
You're very, very welcome. And I must say as well, I'll go back to what you just said there, Henry. We did the Master Investor Show, if I get my dates right now, end of March, if I remember rightly. And Paul was behind us at that stage, or in front of us, sorry. At the back, doing all the different bits and pieces, and we got up and we delivered that show brilliantly because of Paul's technical nous, and Henry and I, as Henry said, blathered on. And then we did the Investor Summit, which I co-founded, and we did that in August. And again, Paul was absolutely smashed that again on that show. And that was the one that we actually had a special guest, where we nabbed somebody out of the audience, and he's hiding his face in embarrassment now. But Matthew came up and we pulled him out of the stage, completely unplanned, and much to Henry's bemusement, I pulled somebody from the audience, and we had a fantastic day then. But again, all down to ShareScope, and all down to Paul delivering the screen and the things ever so smoothly for us. So a big thank you to you, Paul, and to ShareScope. One last mention: if you haven't donated yet, www.justgiving.com/page Peter-Higgins. That's the MENPHYS Just Giving page. Please make a donation. Please donate £5, £10, whatever it is you can afford to do. And let's just push on a bit closer to 5.5K for MENPHYS, and get a young person into gainful employment in 2026. Ladies and gents, I'm going to count to 3 in a minute. Everyone's going to wish you a Merry Christmas, and we're going to wish you good tidings. It's been a difficult year. We've already just saw, I think it was, I'm getting the bearings right now, a day ago, what happened in Australia. Absolutely despicable stuff. People just chilling, relaxing, enjoying a wonderful time. And the peace has been broken by somebody choosing to do that. It shouldn't happen to anybody anywhere in the world. And I just want to send, blessings and good tidings to those families as best they possibly can, and condolences to them as well. And hopefully they get some healing beyond their griefs that they're experiencing right now, because it must be amazing to have lost somebody just like that, who's just gone to the beach, chill out, you're not going to see them again. So let's just give some thoughts and prayers going forward to everybody. And you guys, ladies and gents, wherever you are, hold your family closely, hold your loved ones closely, and stay blessed. 1, 2, 3, ladies and gents. Can we have a Merry Christmas to everybody? 1, 2, 3. Merry Christmas, everyone. Okay, that is a wrap for this podcast. We'll see you all later.
Twin Peaks Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.